I'm going to take a moment, introduce myself, Caitlin Grady. I'm an associate professor here at George Washington University in the Engineering Management and Systems Engineering Department. I have several wonderful panelists here. We're about to have a dynamic conversation. And I will introduce them as they go through their opening remarks, and then we'll dive into some interesting questions. So I will introduce first, to my left, JP Helveston, an assistant professor of engineering management and systems engineering. So give us your opening remarks, JP.
All right. It's a great department, right? Yeah. I have some slides. We'll see if we can pull these up. I'm going to try to just mostly set the stage for understanding the global situation between the US and China. Let's start with a bar chart. Sure. So this is the transition to EVs in China. I like showing this one. It's extremely clear what's happening over there. So this is sales. The gray bars are combustion vehicles. The red is EVs. So the transition is underway, but the scale is really important. I mean, look at that y-axis. Those lines are tens of millions. So about 10 million EVs were sold last year in China. That's close to half of all new car sales. But the other thing that this kind of masks that is underlying is who are the car makers in each of those bars, right? So the gray bars are your multinationals largely. This is like Toyota, GM, Ford, all of your big multinational brands selling mostly gas cars, gas-powered vehicles. They're quickly losing market share. That technology has been in decline now for a while in China. And it's being replaced by primarily Chinese companies. Those red bars are mostly BYD, NIO, XPeng, Geely, a lot of companies a lot of people over here have never even heard of. Except for Tesla, Tesla's the only non-Chinese car company that is in the top 20 selling EV models in China. So China's market is not just becoming more electric, it's also becoming more Chinese. And this is the direction that the global industry is going to move. I mean, wherever China moves in terms of automotive is where the rest of the world's going to go. And one thing that's driving that, and we can talk about the history if you want to get into like where this all came from. But what's driving it today is now just price. Chinese EVs are just cheaper. They're more affordable. We've crossed this threshold. That zero line is really important. This is the percentage premium compared to an equivalent gas car in between electric and gas. So China's EVs are now less expensive, just a straight up price tag, unsubsidized, than a gas car. And so we're at a point where it's just sort of a no-brainer to buy electric. That is not the same in a lot of other parts of the world, especially here, where average MSRP is about $60,000. So we have an affordability issue where China is producing not just good quality cars, but also a lot less expensive vehicles. And that puts our auto industry in a tight spot where we're going to have a hard time selling here at home, but potentially even harder time selling abroad if we can't compete. Now, we're not doing anything. I mean, we're not sitting around. Like, sales are happening here in the US. I mean, we're going on our own hockey stick curve as well, but it's just a smaller scale still. We're at 10% of cars, new car sales. China's at 50. So we're looking at 1 million cars last year. China was, 10-fold that, 10 million. And so things that don't help, tariffs don't help affordability. I mean, this is one of the big problems right now is getting these cars down in price, making EVs more affordable than gas cars. But the second piece here that I want to highlight is we've also gone down a path of the narrative of competing with China so heavily that it's also made it almost impossible to do any sort of partnership with China. And I think there should be room for that. I think there are some strategic things we could do to partner with China, some of the leading technology firms in particular around batteries, to try to find a pathway forward that enable us to get more competitive technologies that lower costs. And my last thing I'm going to end on, which is just a different thought, that in my opinion, the biggest competitor to an American EV is not a Chinese EV, it's a gas car. Gas cars are still the dominant technology in our sector here today. And as long as we have really cheap, especially used, affordable gas cars, it's going to be really hard to sell that electric car. And so making our cars, our EVs, more attractive, more affordable, I think that should be our goal. And I think it's really important, not just for our own market, but for our competitiveness abroad. Okay.
Great. Thanks for those opening remarks, JP. To JP's left, we have Nick Nigro, the founder of Atlas Public Policy. Go ahead, Nick.
Thanks a lot. And since we're at a university, I feel like I have to start with something about school. So when I was in graduate school about 15 years ago, everything when it came to climate and energy policy was about market-based mechanisms. The price on carbon, make the polluters pay, take that money and reinvest it in new technologies, et cetera. Fast forward several years, we tried debating that in Congress here in the U.S. Did not happen. But we did get the Inflation Reduction Act, and we did get the Infrastructure Investment and Jobs Act. We did get considerable amounts of investments, lots of carrots, not many sticks, essentially. And that was the form of industrial policy that the Biden administration put forth. And it led to what I'd like to consider a manufacturing renaissance here in the United States. If you look at a graph of, speaking of hockey sticks, if you look at a graph of investments in construction for manufacturing in the United States, right around the time of the infrastructure law being enacted, there was a huge upswing. And we continued that for several years. In the case, and this wasn't just about EVs, it was about chips, it was about a number of other technologies. But if you focus in on just EVs and batteries, you saw over $200 billion of announced investments to build factories across the country. I know folks have been talking about this so far in the other panels today. But it's critically important that this is a once-in-a-generation moment when it comes to manufacturing and a once-in-a-century moment when it comes to the transition from combustion engines to electric vehicles. So we have all of this momentum going in, and we have an administration now who largely has similar goals, frankly. It is to build things in the United States, to reindustrialize the base of the U.S. economy. Very different tactics at the moment. We see tariffs, we see other tactics that are not unclear about exactly how they're going to play out right now, but they're certainly not getting positive responses from the market. Seeing slight upticks in the number of cancellations in factories and other investments, but very unclear if any of that's just in the noise because there's such a large scale of investment going on right now, or if it's a reaction to the policy. We still have to figure that out. But what is clear is this is all now at risk when we look at what's being debated in Congress with the federal tax incentives and some of the infrastructure law programs that are under the microscope at the moment. There is a lot at risk right now. And if we don't continue on the trend that we're on right now, it's of my opinion now, I used to think that if the United States pulled back from EVs considerably, we would be an island of tailpipes is what I used to describe it as. So we're a big market. We can support a lot of companies. But what's happened in the 8 years since I started talking like that, China has started to manufacture EVs at considerably less cost than building a gasoline vehicle. So now, in my opinion, it's not whether or not we'll be an island of tailpipes. It's whether we'll have an auto industry at all, and will we just be buying imports, essentially, of electric vehicles, because those would be the cheapest vehicles to make and operate, in the same way that we import a lot of technologies. And so that's the risk, and that puts at risk not just our U.S. economy with many millions of jobs dependent on the auto sector, but also our national security and our energy security, because we don't really want, as a country, to have a dependence on such a vital part of our economy on nations who don't necessarily share our values.
Great. Thanks. And next to Nick, and last up for the opening remarks, we have Albert Gore, the Executive Director of the Zero Emissions Transportation Association.
Yeah, thank you so much for having me. And I just want to say what a great program, what an excellent group of presenters. I'm a daily user of Jay Turner's website, and also a longtime customer of Valid Policy, as everybody should be.
Thank you.
But this has been a really excellent presentation. Zeta's an association of 50 companies across multiple industries, united around encouraging a transition to electric transportation. We have an excellent group of electric utility members, charging companies, battery and EV OEMs and recyclers, and critical mineral producers. I say critical mineral. I use that term loosely because it's a moving definition, but mineral producers and refiners in the United States. And so I think that's a really important place to talk about the impact of what's happening now in the context of the progress that's been made over the last decade and a half. It's amazing to see the path that China has charted over that time. It kind of starts with the Olympics in 2008, but a sustained decade and a half effort with, really massive policy levers on the demand side, on the supply side, and it's sometimes most striking in the mineral sector. And the challenge of developing a non-Chinese supply chain for minerals and battery components is really, really significant. Tariffs have a huge impact on that. I think one of the major issues facing the United States in developing a supply chain for minerals outside of China's sphere of influence is how to do that in a market-based way when you're producing a commodity that needs to be financed against a global commodity price that is set by a country that is not a market economy, and that often, frequently produces and sells products below their cost to produce, and is able to do that for long, sustained periods of time, much longer than anybody, when they first encounter it, think they'll be able to, but they do. So what's been maybe, at least in our sectors that we serve, the biggest, most demonstrable, measurable impact, market impact of the tax policies over the last several years has been on that market because of the series of demand signals that are contained within the IRA to pull investment from global multinational mining companies and refining companies that don't just bring investment, but they bring human capital, IP, but also just it's a tug of war between those resources that are going to China or into markets that are increasingly being served by China as China's approaching, the majority of the global vehicle market. So I think we're trying not to take our eye off the ball on what the impact of that policy has been as it's currently being debated. But, the North American supply chain for automotives in total is incredibly important. I think trying to make decisions based on tariffs on longtime FTA partners is tricky because one hopes that they will not be at the current level permanently. But because of with regard to China in particular, because of the Inflation Reduction Act and the response to that policy, our industry is perhaps, has some momentum in this direction to regionalize the supply chain. I think, we will benefit from being able to rely on long-time trade partners like Japan, South Korea, Canada, Mexico. And so, we're watching that very carefully, and we want to participate in that very thoughtfully and carefully. But the goal of securing the supply chain for these critical materials is very, very achievable. We could take a huge step backward if we're not mindful of that. But I think that there are a growing number of folks who really understand the progress on a global sense, on a national sense, and increasingly at a district level, thanks to all of the efforts of a lot of folks in this room, to really tell the story of what's happening in communities across the country. People are really excited about it. So everyone's feeling the impacts of tariffs, but we want to keep telling that story as clearly as we can.
Great, thanks. Maybe I'll start with a question to you, Nick. In your opening remarks, you and JP both sort of referenced that China is really sort of eating our lunch on production these days in the EV market. And I'm curious if you can elaborate on the national security bit of this. So how should we weigh national security concerns against potentially, short-term economic pain for consumers here in the U.S.?
It's a really important question because it gets down to, how much of the investment, particularly from the public sector, is going to be allowed to be put into the automotive and batteries and energy in order to, keep us competitive and allow us to sort of re-enter the leadership circle in this space. Back in 2010, when we were first looking at the new entrance of electric vehicles, the United States was right at the top. We had factories that were coming together. We had the Chevy Volt, we had the Nissan Leaf being built here, and we were clearly in the lead in some respects. As you were saying earlier, we took our eye off the ball in that case, and we lost our way for some time. And what that's resulted in is us having to play catch up, which means it's going to be more expensive now than it perhaps would have been had we been chugging along at a more rapid rate in the 2010s. But, when it comes to our security, it's hard to put a price tag on that. The U.S. spends more on defense than many nations combined. So that's one thing. There is certainly a security angle to it, but there's also a critical economic angle to it, and that is our ability to use soft power and work with other countries. You mentioned the allies and the potential for us to set up alliances to extract minerals, to develop technologies. We need to be able to do this because, in my opinion, the most technologically advanced things that humanity makes at scale are vehicles. And the reason electric vehicles are more expensive is because of the battery system in there. And that's an even more advanced technology. And so we've got to be in that race if we're going to be able to continue to be in the leadership circle in technology and manufacturing in the world.
Great, thanks. JP, I'd like to come back to affordability. In your opening remarks, you touched a bit on the affordability crisis, especially here at home. So how does the U.S.-China technology relationship feed into or exacerbate this crisis for everyday Americans?
This one's tricky. Yeah. So I think it depends on how much we want to engage with China or not is kind of a key question, and in where. Right now, the strategy seems to be just don't engage in any way, like ban everything essentially, and don't even really partner with any of the supply chain. I think there's a middle ground. So on one front, we've talked about the upstream supply chain, like minerals and things like this, and there are a lot of reasons why I think replicating that outside of China is probably a worthwhile endeavor for security reasons, for economic security reasons. That one requires partnerships, that requires trust, that requires allies and trading partners, and so we're really stressing those right now. But mending that and trying to build that out is probably a worthwhile endeavor. The other side, though, is the technology side and like what's in these batteries. And this is an area where I think the relationship and the tension between the U.S. and China, we've got to resolve some things here. There's some big opportunities to take some of the best, right at the frontier of the technological scale in batteries in China and license that technology here. I think there's a long history in automotive of when you realize you're behind, that what you do is you go to the competitor who's ahead of you and you learn from them, right? You partner with them, or you work as much as you can to figure out how are they achieving that and bring it back home. And so things like that could be done. We've seen potential proposed deals like the Ford CATL deal, but those are getting a lot of political pushback. It may not be a law that's stopping that deal from happening, but there's political pressure, and there's this narrative that China is the enemy in all ways that I think is really detrimental. I think there's lots of opportunities for private companies, private entities, to work with our automakers to help us catch up on some of that technology. Ultimately, that will all bring costs down. But so right now, the tension between the U.S. and China is a sort of no negotiation, really, and that's, I think, the worst situation. That's not going to help the affordability problem.
Nice. Great. Back to you, Al. So you work with a lot of different manufacturing battery companies, upstream supply companies. So I'm curious, in your orbit, are these manufacturers and companies seeing more upsides from recent legislation, the IRA and the IIJA and the tax incentives and subsidies, then potentially being hurt by geopolitical risk or tariff policy, or can we not decouple those things at the current moment?
It's a good question. One of those policies has been in place for 2.5 years. and the other is a few days old. But I think, the future of the IRA credits with regard to vehicles are still very much up in the air. So, I was thinking about one of the prior questions as to what other levers are there out there to pull, and I agree with the previous panelists that like the biggest lever to pull would just be like keeping things steady for a little while, so that everybody knows what the trade landscape looks like, what the tax landscape looks like, and can make business decisions based on that. But I think trade policy is going to change over time, and there are a couple different ways it can: negotiation, legislation, but and then there are ways to engage with tariffs on an individual company basis to try to, get a common sense, ruling on some piece of machinery, equipment, et cetera. So I think what's clear is that if you are interested in getting companies, both domestic and foreign, to invest in manufacturing in the United States, the 45X credit in particular has been incredibly effective in encouraging that. It's a very open question as to whether IP licensing from cattle is going to be allowed in that final, whatever comes out of this reconciliation bill. I think, Rob Meyer gave, in the Atlantic, I think, the best explanation for why, in his view, it's very much in U.S. competitive interest to allow things like that. And I think a lot of other groups have weighed in that way. What is really, really, I think, tied up with what Mike was talking about earlier, which is public sentiment around EVs, is the degree to which there's an appetite to include a demand signal, a deployment credit to support the factories that are being built on the expectation of the production credit. If we want to build everything here, or certainly we want to build the most high value things here, then that makes a lot of sense. China did that in its own way by essentially creating an infinite demand pull for batteries being manufactured in China, which created an nearly infinite demand pull for minerals coming out of the ground around the world, being processed around the world or in China. That was never an issue. They electrified 200,000 transit vehicles, in a 5-year span. And now they've moved on to finished vehicles for export. That's what China's doing right now. But they can make policies like that. In the United States, it's funny, I was listening to a market analyst show yesterday on my drive into work. And they were interviewing somebody on tariffs. And at the end, they had a discussion about, wouldn't it make a lot more sense to do this over, a longer period of time with something like tax credits? And I was like, that's a good idea. We should think about that. Yeah, I'm going to take that to the hill. And I think last thing I'll say is what companies can do, independent of public policy, when they have local support and they have enough, commitment. I was just in Reno at Panasonic's factory there. That factory started in the Obama administration. We're 3 administrations forward in time, multiple governor administrations in that state. But it's a phenomenal company that was embraced by the community. They got a good local representative, Mark Amade, who believes in that project. Over 10 years, now they manufacture 6 million battery cells a day. So that's the kind of thing that happens over 10 years. If we don't massively derail, the inputs and all of the things that companies have to weigh into their risk when they're investing in the country. But it's a huge success story, and we've got 50 other examples that could be that in 10 years around the country if we can, find a way to not massively increase their inputs cost or pull the rug out from under them if they've invested on the assumption of, a pretty common sense incentive that's been in place for a few years.
Yeah, please add on.
Thanks, you've inspired me. So a couple of things that Al said made me think that I wanted to share some other thoughts on how historic what the Inflation Reduction Act did and the infrastructure law, but also the other administrative action that was taken under the Biden administration. The vehicle standards, just as an example, are a critical linchpin of making sure that more of the market is moving towards electrification than just new factories being built or consumer credits. In addition, there's an important tax credit around infrastructure that really makes it possible, which, by the way, charging stations are a really hard business model. So having that kind of tax incentive there and a national electric vehicle infrastructure program is very important to make sure the infrastructure is out there for people so that they have confidence that they can buy the vehicles. All of these little things are working together towards one goal of advancing that adoption curve. You take any one of them out, it's not gonna collapse like a house of cards, because it's not. It's a multi-trillion-dollar industry. Universally, all of the automakers who aren't already zero emission have said they will be by some year in the future. So it won't collapse, but it'll certainly slow down. And when you're looking at it from a globally competitive standpoint, there are moments when you slow down too far and you can never catch up. And that's when really the point of no return hits. And we're getting close to that right now. And so that's why all of these little pieces are really important to keep in place. When you think about how that will translate in Congress, that's very hard, no doubt about it. But the extent to which states like Colorado and other leading states can help fill in some of the gaps that might get introduced in Congress, we can keep on the trajectory that we're on right now.
Great, thanks. I'm going to take facilitator's liberty and ask a few more questions of the group here, but I want the audience to be thinking about questions because I want to leave a lot of time for what you're interested in getting reaction from the panel on. Maybe a question. I'll throw out the first question about the last 7 days of public policy, and whoever wants to answer it can. So, this current administration has just implemented tariffs across nearly the entire global economy. I want to know, relevant to this conversation, what are the immediate risks to the EV supply chain? Who is going to be hit first, and what should we be monitoring in the coming months to assess either damages or shifts in strategy as a result of these actions?
I'll give a quick answer, which is...
it's not good.
Yeah, it's challenging. But to use some specific examples, one of the hardest parts of the battery supply chain to onshore is, just upstream of the cell, between mining and refining and when you get to a battery cell. You have cathode active material, anode active material, separators. I mean, these are the things that at a mature battery factory are just like they're humming. They have mature supply chains for these things. We make in North America about 1% of global cathode active material production, maybe 5% of anode active material. But in terms of battery material imports, which include those three things, more than 50% of our imports come from long-time trading partners, allies, Japan and South Korea. And they are going straight into factories in the United States that are powering thousands, tens of thousands of U.S. jobs, either currently or, many more in the future. LG's got 7 plants, either in production or announced around the country. Panasonic's building a bigger factory in Kansas. Samsung has a massive facility in Indiana. SK has joint ventures with Ford across the country, including Tennessee. And so I think, which I always have a special place in my heart for, I'm rooting for that place, that factory. So the point is, and SK's got a huge factory in Georgia too, North Georgia. We got to figure out how to deal with, 23 and 25% tariffs that are not, it's hard to understand where they come from, and it's hard to understand how they could last very long. But there's a direct impact to U.S. manufacturing employment currently and phenomenal growth expected in the future in a lot of states that desperately need investment in their manufacturing sector. And it is a mature, growing, non-Chinese supply chain for critical battery materials. So I think, we got to work through that. I think there are a lot of folks that will understand why we need to make sure we don't disrupt that.
Did you want to add, JP?
I'll just make the point. I mean, it seems like there is a bipartisan consensus that building a secondary supply chain outside of China is in our interest and in the world's interest, and we cannot do that in only the United States. It's impossible to make all of those materials. I mean, everything you just heard is the reality, right? You have to have trading partners. You have to have trusted trading partners who you can trust that we're going to have this relationship for a while, that things are not going to be fluctuating wildly. So if we have this sort of instability, it just plays right into the hands of a Chinese supply chain. They get stronger, we get weaker. It's very clear how that's going to go. The other thing, though, that I want to emphasize is that the rest of the auto industry is also going to be massively disrupted by this, like potentially even more so. Like internal combustion engine is going to cross the border. Sometimes the parts in those things will cross the border 4 or 5 times before they end up in the engine. So the final tariff on a internal combustion engine might be many more percent than it looks like on paper. So ironically, they might become so expensive that EVs get better. I don't know. I don't think that's going to work out. But not rooting for that outcome. I think that's a bad outcome. But the point is that there's a lot of other parts that are shared between both powertrains. Brakes and steering wheels and tires and steel. And I mean, the whole industry is going to go through a massive disruption. And when you start seeing plants close, like that's the stuff that takes a very long time to restart. So it's when something gets cut off, it is so much slower and harder to rebuild. Communities leave, people leave, talent leaves. So these kinds of things that look like short term, like we'll just dial the tariff back or something a month later. Even that could be enough to really throw a wrench in long term plans.
Can I give a quick example on this point? Because when the tariffs hit, and I'm a data person, so I'm looking. Like, well, what can I look at? What kind of insight can I get from the data? And so we work with a number of states who give us vehicle registration data, the VIN. And so in that VIN, you can find out where the vehicle was assembled, essentially, what country. And if you look at the data by state, we have a few different states, and you look at some of the most popular models, you've got a very different distribution of the vehicle share that's imported versus domestic for some of the most popular vehicles, just depending on the state. And that's the evidence that you need to know that the industry set up the supply chain based on the certainty of what tariff policy was to look like. So they're not thinking, oh, I need to make sure that equal share of vehicles go to one state or another. They're doing the most efficient thing to get the product to where their customers need it. They're not going to charge the state, the customers in the state where they happen to have more imports than the domestics. They're going to raise the price of all of the vehicles, and that's going to hurt not just imported vehicles, but domestic vehicles. So to your point, this is a very broad automotive-wide issue. EVs will be affected, but I can't imagine it not being just as substantial in the whole sector.
Great. Well, I want to bring back up something that you made reference to. We have very limited current capacity in our cathode, a tiny bit more, but very small in anode. So I want to talk a little bit from anyone's perspective on the panel. Like, can we do this? Can we grow our domestic production? How do we do it? What are our strengths and weaknesses? If we have to be strategic about the most important areas to be supporting, what does that look like for anyone?
I'd be happy to jump in. I think starting with the far upstream mineral production and refining, I think, again, the measurable impact of the IRA has been on incenting automakers in particular, and Ford's a great example of this, early example of this, doing a joint venture for lithium refining with Ioneer, who's one of our member companies in Nevada. That's a globally significant lithium asset that's coming online very shortly. They also produce boron. Refining in the United States in partnership with an automaker. GM is doing something similar with Lithium Americas in Nevada. But I have a dozen other examples of offtake agreements for mineral production in the United States. And I think those are at risk if the 30D credit goes away, because they are all sort of contingent on the value of the 30D credit. There is a certain amount of, demand for domestic production from mature producers that aren't the most price sensitive in the market, who will say, I want to localize my supply chain as much as possible and I want to support these. But if it's 3x or 2x what I can buy in the global market, that's a problem. So smart policy that creates workable demand signals and tax policy, I think, can definitely do that. It has been doing it. We're sort of in a risky period of potentially taking some steps backward on that regard, which will mean some companies, some less well-capitalized companies, maybe delaying for quite a long time. But I think on the cathode active material front, that is something that we really desperately need to grow in North America. So it's really important to look at where there have been opportunities there, and to find ways to build support over time as the midstream continues to grow, the battery production and the vehicle production. It doesn't make sense to strangle the midstream and downstream production in the supply chain to benefit, the upstream production. They all kind of grow together. But I think first and foremost, the goal of creating non-Chinese supply chains means, including these things in trade policy. And, you can look back at the 80s and, there were examples of this, of trade policy that sort of incorporated the need to maintain a really strong, robust supply chain with a trading partner while you were developing that domestic supply chain yourself. I'm not suggesting should be replicated now, but I think that's the goal. Is we have really good relationships with countries that have giant companies that have made giant direct investments in the United States. So let's maintain that relationship as they help us to build this domestic supply chain, along with our American companies as well. So we got to get through this trade uncertainty and tax uncertainty. Maybe by the end of the year, we'll know what the playing field looks like. But we're really set up to win once everybody knows, what the rules are.
There's an ingredient to success here that doesn't get as much attention because it's frankly not as much money. And that is the existing federal programs that support research, development, and demonstration and deployment. And also providing low-cost capital to businesses who are looking to either manufacture or deploy a new technology. The Department of Energy has seeded the growth of a lot of companies that are in this space. We have plenty of researchers in the U.S. who have that next generation technology available to them. They need, startup capital. They need access to national labs. They need access to other facilities in order to sort of get through the stage towards mass production. And when they are near that stage of mass production, they need access to lots of capital at low cost. And we have that program in place right now, the Loan Program Office, which if it didn't exist, it'd be hard to know if the largest market cap company in the auto industry would be here today, because they got a loan program, somewhere about 15 years ago or so now. And that's yeah. So my point is that the ecosystem, I've talked about all these things in the air that are really important to hold them up, and if anything falls, the house of cards, it's not a house of cards. It'll continue. It'll just go more slowly. The federal programs in place, like the Loan Program Office and the grant programs that are at DOE, these are all also part of that ingredient to success.
I feel like we should have a whole nother panel on the scientific enterprise and sort of next generation technology development, because you're right, so many of the innovations that have come out of the United States have been in partnership with programs through the federal government, and that's important to recognize if we want to continue to and create the next generation technology.
I'll add one more little piece, which is that investing in battery plants in the U.S. kind of makes a lot of sense for a lot of different reasons outside of EVs. I mean, we just talked about some, having places to do demonstration projects and so on. But this is a general purpose technology. We're going to need more and more energy storage on the grid, just flat out, if we want to achieve any of our climate goals. But also because that's just going to become more affordable. You're seeing people put solar on their roofs and put a battery in their home. That's becoming a very common pattern. So there's lots and lots of other markets for batteries, and having them here makes a lot of sense. So this is an EV panel, but batteries is one of these central nodes in the clean tech ecosystem. It's probably the most important node. So just putting that out too.
Okay. Maybe I'll ask one more question before I flip it to the audience here. We've been talking a bit about the US and China. I want to take a little bit of a step back and talk about how do you think other countries are responding to the US's push to decouple from China, especially in the energy EV technology space? Are we at risk of falling behind globally, even if we make some ground in domestic manufacturing? What are your views?
Yes, we're at risk. I think if you're a company that is currently producing products that go into the battery EV supply chain, and you're mature or you're growing, you've most likely looked at the U.S. market as a great growing market, and if that is sort of frozen in time or becomes more expensive. At an enterprise level, folks have debt, they have payroll, they have huge investments they've made, and they're going to go where the market is. So there are many examples where it is essentially a zero-sum game as to whether we're pulling that into the United States or into the group of FTA countries that we've been working with on mineral partnerships. Or it's going into China, maybe in their domestic market. Sorry, I don't mean to bring it right back to China. But it's true. I mean, I think that there's a gravitational pull for, there's a lot of global demand for these products. They're much less controversial around the world in economies that are a bit further along in EV adoption. A lot of the charging issues, a lot of the cold weather issues, et cetera, they're less... I'd say like profound to people in the consumer market because in general they sort of, there's a lot of problems with cars in general that I know how to deal with a dead 12-volt battery because, it just was knowledge that was passed on. Most people don't really know how to deal with dead 12-volt in an EV. They may not even know there is a 12-volt in the EV and that you can't actually charge it if the 12-volt's dead. You got to jump that first. So anyway, there's like that in Norway. Everybody knows that already. So there's a huge market for vehicles that's pulling all that stuff into it. And, again, China's kind of moving to finished vehicles. So there's a huge demand for battery materials. That's the risk of us putting the brakes on everything.
I want to emphasize our relationship with Europe and how that's going to be really critical. The European automakers, I think, are very aware of China's leadership in EVs and are forming partnerships. They're getting direct investment from Chinese automakers. They are operating facilities in China purely for export back to Europe at this point because it's so much more affordable to make the vehicle there. So they have an intimately tight network with China, and if they look over at the U.S. and they see a country that is pulling away from partnerships and slapping tariffs on them, I mean, there's really only one other entity to work with now, which is just to continue to double down on partnering with China, and that's enormous risk of of seeing the European-Chinese alliance around EVs grow while we fall even further behind. So that's one that I'm paying a lot of attention to. Somewhere earlier you asked about what should we be paying attention to. I'm tracking exports from China to Europe. I'm tracking investment from Chinese investment into Europe and seeing is that comparative to what's going on in the U.S. I think that one's going to be really significant.
Okay, with that, thank you very much to the panel.